right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack, founder of Better Books, CPA, certified tax planner, MBA, and I have set out to help you, the American taxpayer, the business owner, the investor, the real estate professional, to save as much as possible on tax. And part of that is always staying up to date on tax implications, tax changes, tax law, tax rulings, because you see that there's Internal Revenue Code, which is the tax code that most people are aware exists. And then there's court cases that then interpret that Internal Revenue Code and make decisions. And then there are publications that come out, and then there's changes to the tax code and the law. And all of this combines into what influences your decision and what deductions are available to you and how the IRS would approach it if you were to get audited, like all of that. Any one of those things would be hard enough to stay on top of it, and all of them combined are even harder to stay on top of, especially for you, the business owner, who are out there trying to grow your business and provide for your family and leave a legacy. And so to think that you are also going to be aware of the tax code and what deductions you can take, what accounts are the best, what the new law says about what is available to you, is a bit crazy. And so that's why we partner with you and make sure that we know what's going on in the tax environment, and you can continue to build your business so that when taxes come, we have some strategies to implement to help you pay less in tax. And so over the past 4 weeks, we've been interpreting this big, beautiful bill that passed through the House, and at the time of this recording is in the Senate. By the time this is released, very likely is reaching the end of that time. And because they said that the 4th of July is kind of their deadline, their internal deadline, now we know that politics and lawyers and everything else that has to do with the law could get pushed out and extended, and you never know what's going to happen. But if things have passed and know more than I do at this current time of recording, then hopefully that this is all good news. And if anything did pass, what we've been going through is now in law. And I say hopefully because it makes for a more fun tax environment, more fun tax strategy implementation and thinking process that we go through here at Better Books. I've mentioned that there are some senators and people that have voiced their concerns about this big, beautiful bill because of the debt that is at our nation. But this is a tax discussion and not an economic discussion, although I don't think that that should go without being thought about or mentioned, because debt is not good. The borrower is a slave to the lender, and we don't want to be enslaved to any other countries, especially those who have adverse ideas of how things should operate here and around the globe. So that is my 2 cents on the debt, but let's talk about taxes. So up to this point, we've covered things related to real estate. We talked a lot about qualified opportunity zones and bonus depreciation being adjusted, extended, both bonus depreciation and opportunity zones. We talked about qualified business income QBI deduction, section 199A deduction being made permanent and increasing to 23%. Those are both the previous 2 episodes. And then the first episode that we did was about no tax on overtime. And I didn't talk about the no tax on tips, but that is also included in this bill. Today, we're going to be talking about what is being removed. What things should we be aware of that maybe we've made use of in the past that are not going to be part of this big, beautiful bill, this new tax law, as it goes through the Senate. And whether you're aware or not, maybe some of you are aware, most of those related to recent tax changes that came as a result of the previous administration. President Joe Biden was in office. He and his cabinet and the Congress that were in charge at that time had Build Back Better, which was an approach to the financial standing of this country post-pandemic, and it was their way of incentivizing growth, although a lot of it had to do with some of their interests. And I'm not saying that this one doesn't have anything to do with President Trump or his cabinet or Congress members' interest. I mean, real estate is an interest of theirs, no doubt. There's stuff in here related to farms, there's stuff in here related to banks, there's stuff in here related to overtime workers and tip workers. And so, I mean, that's what politics is you want to please the people who you promise to please, and the others, who knows what your goals are with them. But it's our job to interpret what this big, beautiful bill says and what the tax law could say, assuming it gets passed. So without further ado, let's provide some insights. Let's provide you with some confidence about what's going to happen in the event that this passes as law. or at the very least, you know what things are being talked about or considered, and that's usually a trend for what could happen if it isn't already going to happen. So there is a termination. So it's interesting. This bill, they break it up in different sections. So in previous sections, the first subtitle is Make American Families and Workers Thrive Again. That's subtitle A. Subtitle B is Make Rural America and Main Street Grow Again. So subtitle B is where you get qualified opportunity zones. You get increased investments in those rural areas. Subtitle A, American Families and Workers Thrive Again. That's where you get the taxes or no taxes on tips and overtime. They also talk about the tax brackets being made permanent, the decreased tax brackets being made permanent. We didn't do an episode on that, but it is an extension of the modification of the rates. I guess it's not made permanent. I said made permanent, but it is in 2026. They're going to keep the tax brackets as they are now in 2025. The way it is that those tax brackets are actually going to expire, the ones that we have now, and those are decreased tax brackets, and then they would increase to what they were pre-2017. So the highest tax bracket would bump up from 37% to 39.6%. The 24% would see the greatest increase. So that's where a lot of Americans fall. 24% currently would then bump up to 28%, 22% would bump up to 25%, 12% would bump up to 15%. Like these have significant impacts on the everyday American, especially those lower income Americans who are in those lower tax brackets. They've been seeing more dollars come to them on a regular basis, haven't paid as many in taxes. If current law stays and this bill, this big beautiful bill, does not go through, then we're going to those increased tax brackets, and we need to consider that. Right? I don't think it will get to that point, but I mean, depending on what happens in the Senate, it very easily could. So going back to what I was talking about, the second part, subtitle B, is Make Rural America and Main Street Grow Again. And then this one, where we will be focusing our time, subtitle C, it starts off with Make America Win Again. Part 1 is Working Families Over Elites. And this is where we'll be focusing a lot of our attention, because this has impacts on people who have made use of some of these benefits. So think about the benefits that came as a result of the Build Back Better. A lot of them were focused on the renewable energy industries, right? Clean vehicles, solar and wind power, different opportunities available to you, the American taxpayer, by investing in these areas of clean energy, clean vehicles, clean production that would yield you a tax benefit. The big beautiful bill is removing some of those. In part 1, Working Families Over Elites, the first section is termination of previously owned clean vehicle credit. The next section is termination of clean vehicle credit. The next section after that, termination of qualified commercial clean vehicle credits, termination of alternative fuel vehicle refueling property credit, termination of energy efficient home improvement credits. The list goes on. Residential clean energy credit. So what they're proposing is that all of these clean energy credits that really came in the past 2 or 3 years in the Build Back Better, Joe Biden and his presidency and his cabinet and his advisors, they got a bill through that basically put into force all of these. This is getting removed. So let's just focus on the first 3. We'll start with the termination of clean vehicle credit. So under current law, taxpayers may claim a tax credit of up to $7,500 for clean new vehicles placed in service in a given taxable year. The maximum credit is comprised of 2 equal parts. The first $3,750 credit value is determined based on the critical mineral sourcing of the vehicle's battery, and the second $3,750 credit value is determined based on the sourcing of the battery components. Credit is limited to incomes of $150,000 for single filers, $225,000 for head of household filers, and $300,000 for joint filers. Credit is available to vans with a MSRP of $80,000, SUVs with an MSRP of $80,000, pickup trucks with an MSRP of $80,000, and other vehicles with an MSRP of $55,000. The credit is set to expire December 31, 2032. The provision accelerates the expiration to December 31, 2025. This provision also implements a special rule for taxable year 2026 that only allows vehicles produced by manufacturers that have not sold 200,000 new clean vehicles as of December 31, 2025 to qualify for the credit. So we have seen clients make use of this credit. This is things like Tesla. When you buy a Tesla, this was the selling point of a lot of people. And we've had people get sold their vehicles and then find out that they don't qualify because their incomes are too high or too low. In some regards, we've been able to tax plan around it. And so what this is saying is that what was a $7,500 credit is no longer a $7,500 credit. You do not qualify for it because it is no longer a law. So now you're going to see less of an incentive to buy these clean vehicles. And you could say that there's probably some politics behind this. There's probably some people that are upset that they did this because it depends on where you fall. But a lot of people think that this focus on clean energy and renewable energy is kind of detrimental to us. We're lowering our standards of excellence to save the environment that might not actually need saving. And don't go chop that up and say that I'm some climate denier, but like a lot of people are saying that things like the batteries that are in these vehicles are actually worse than the emissions that we put out in our cars, and the cars don't operate as well as the cars that we're used to. And the fact that we need to charge our cars, the 300-mile mark kind of puts us at cause for concern because there's not chargers everywhere like there are gases. And actually the things that go into the making of these cars destroys the environment faster than the gas that we've been using and what we've been running our cars on. So there's this debate, but the point is that in 2022, I think was the Build Back Better bill became a law. And that's where a lot of these clean energy credits came in. And so people invested in things like Tesla and other qualifying Rivian and other qualifying vehicles and got $7,500 either from the government or the actual supplier. And assuming this gets passed, this will no longer be the case. It was set to expire in 2032. They're like, nope, we're speeding that up. 2025 is the last year we're dealing with this. And it starts now, basically. Now, you can say what you want, but there's a lot of other places that we can be investing. And I think that's part of it too, is our dollars best invested in renewable energy, clean vehicles, or is it better invested in parts of our society that might have been forgotten, like the rural America that we've been talking about in previous episodes? That's up for you to decide, but just know that if you're thinking that when you buy a Tesla next year, you're going to get a clean vehicle energy credit, you will be sadly mistaken, assuming this gets passed as a law. The next section is termination of qualified commercial clean vehicle credit. I'm thinking of as I read this is that the Amazon trucks that you see nowadays tend to be probably these clean vehicles. You hear them drive around your neighborhood and they're making those what sounds like supernatural sounds, and they're clean energy. And guess what Amazon's doing? Amazon is getting a tax credit for those vehicles because the tax code says that they get a credit for the vehicle. And so whoever's supplying those is getting revenue, Amazon's paying for them, and they get a tax credit of at least $7,500. For vehicles weighing less than 14,000 pounds, the credit value is $7,500. For other vehicles, the credit value is $40,000. This credit is set to expire December 31, 2032. Provision accelerates the expiration to December 31, 2025. This provision also implements a special rule allowing vehicles acquired pursuant to a written binding contract entered into before May 12, 2025 to qualify for the credit. So assuming you get a contract in place before May 12, 2025, but you might not get your January 5th of 2026, you still get the credit. But anything that's purchased after that date, it expires December 31, 2025. So if you buy it after May 12th and it doesn't come in until February 2nd, it's my understanding that you wouldn't get this credit. But you can see what's going on. And for those, maybe you have a drop shipping company or you have another company that uses vehicles and you've heard that this is an opportunity to save on tax. So you've made an effort to buy these types of vehicles. Guess what? You would not qualify. And if you did this without the right insights, without the right information, without the right understanding, you could go buy a vehicle and then not qualify for the credit, and now you have a vehicle that might not work as well as the one that you would have liked to buy, but because there was an incentive to buy it, you did it, or a vehicle that you didn't need, and now you have this vehicle that, again, isn't the highest quality and doesn't line up with your desires, but because there was a tax credit attached to it, you bought it, but the tax credit wasn't there, right? So there are parts of this big, beautiful bill that are not resulting in large tax decreases. So they are taking away current tax credits for the sake of, well, what they say is the benefit of the American people. Termination of alternative fuel vehicle refueling property credit. Under current law, taxpayers may claim a credit for advancing refueling property placed in service in a given taxable year. The credit value is 30% of the cost of the property not exceeding $100,000. Credit expires December 31, 2032. So again, this has to do with probably those who supply this type of credit. My understanding, if I was a gas station and I put in like a Tesla charging station, then I might get a tax credit for that. But that's going away. It's expiring. I'm just going to go through the list. I'm not going to go through all of the wording, but subtitle C, Make America Win Again, Working Families over Elites. More than 10 sections have to do with a lot of this clean energy credit and carbon emission credits and zero emission nuclear power production credit, phase out and restrictions on zero emission nuclear power production credit. That's interesting because I think there is a desire to solve some of the energy issues with nuclear power, but it seems like that's going away. So I'm not the expert in all of that, but I will say that the risk here is that you, the taxpayer, aren't aware that these changes are coming. And again, some of these things can be sold to you without being 100% true or honest. And that's the risk, is that you go to a Tesla dealership and they say that this qualifies for a $7,500 tax credit. And then you find out next year when you don't get the tax credits that you are no longer eligible. And now you have to pay $7,500 more on taxes as a result. There's obviously motivation for this and inspiration that they're doing this. They clearly don't want the American people investing in those areas. They would much rather have the American people invest in things like real estate, in things like overtime workers, and things like tip workers, and things like rural areas. This is just a fraction of what this bill actually says, but the end result is the same. You, the American people, need to be aware of what is going on with your taxes. And if you're not aware, you need to make sure that your accountant, your CPA, your tax strategist is aware. Otherwise, you're going to end up being caught off guard with tax changes, whether it's increasing tax brackets, whether it's changes of depreciation. Your accountant might not make use of it. Lower tax credits available, tax credits that you thought were available are no longer available. Like, there's a whole host of ways that you could get this wrong, and that is not what we want for you. And so we would encourage you to meet with a tax strategist, meet with them on a regular basis, make sure they're staying up to date with tax changes. And if you don't have somebody like that in your corner, you're not sure where to go for that, you can reach out to us. We are taking on new clients. We have open spots available. We don't work with everyone, so we do want to make sure that you're qualified, and we look for a handful of things. One of them is that you'll implement our advice. So if we tell you don't buy the clean vehicle because you're not going to get a credit, and you go out and buy a clean vehicle and then come back and say, hey, I didn't listen to your advice, well, that's probably a sign that we're not going to work well together, because we want what's best for you and advice to what we know that is going to work for you and what is in line with your goals and dreams. And if we see that that's not the case, then there's other places to go. But if you do want somebody that is going to hear you out, understand where you've been, know that you're paying way too much in taxes, do what it takes to pay less in tax, get yourself organized so you don't have chaos in your books or in your taxes or with the IRS, then we're probably a good fit. And you want to change. You want to make the change. We'd be happy to get in touch with you and see if it's something worth your while. This is the Know Your Numbers REI podcast. I am your host, Chris McCormack. And until next time, God bless you and keep moving forward.